everybody. Welcome to lesson number 6 of our Fundamental and Technical Comprehensive Masterclass webinar. Today's lesson is how would Warren Buffett trade FX? And it's really a lesson about understanding the fundamentals and the resources available to you as a trader and putting all of those ideas together into a comprehensive, intelligent analysis of how I think the greatest investor in the world would trade. And everything he does essentially as an investor is actually quite applicable to the FX market if you know how to extend his ideas into our market. But before, as always, trading foreign exchange on margin carries a high level of risk, may not be suitable for all investors. I ask you to read this disclaimer very carefully to understand all risks associated with trading on margin and to seek advice from an independent financial advisor if you have any doubts. So, according to Warren Buffett, there are really only 4 things that really count when you're making an investment. 1, a business that you understand. 2, a favorable long-term economic trend. And this is really important. You need not only just to have a good business idea, but it's important that it operates within a conducive economic environment. 3, able and trustworthy management. And 4, a sensible price tag. And this is fascinating because each one of these principles is, I think, highly extensible to FX. And we're going to talk to you about how we can apply the basic philosophy of Warren Buffett to our business. So when he looks at these ideas, he basically makes the statement that that's how you make an investment. Everything else is speculation. Well, our business is actually the reverse, right? We are in the speculation business. But I think we can apply every one of these investment principles into our speculative process. So a business that you understand becomes a trade that you understand. And that's extraordinarily important. And we'll talk a lot about how you can better understand trades. What are the tools? What are the analysis? What are the key things you need to know in order to understand the trade better? Number 2 is the favorable long-term economics, which is the trend in your favor? That's actually one of the easier things to establish. But yet, what's actually surprising is how few people in the marketplace, how few traders pay attention to the single most important thing outside of the trade idea, which is if the trend is in your favor. I'm just as guilty, I think, as everybody else is of doing that a lot of times. Number 3, and something that is grossly overlooked by a lot of traders, is having a reliable broker. Now, we don't recommend any brokers at all because obviously we're very independent. We're not associated with any brokers. But my overall advice is you absolutely really want to trade, first of all, with a regulated broker. So in America, you only have 3 choices, and all three brokers are regulated. Across the world, I would really say that there are 3 regulatory bodies across the world that are respectable. The NFA in US, ASIC in Australia. Well, let me refresh it. There's actually 4. So ASIC in Australia, NFA in the US, FCA in London, and the Singapore Monetary Authority in Singapore. I would say that anybody who trades out of a Singapore-based broker is doing business with somebody very reliable. I don't. If you come from Japan, the Japanese regulators are very, very tough. They're probably the most stringent regulators in the world, and so the same as with Hong Kong. But I don't have any personal experience with the Japanese market at all. And Hong Kong market is very, very good. I mean, if you come with from a reliable broker in Hong Kong, it's also a very, very good market. But the bottom line is, that's a critical thing. Then the next very, very important factor is to determine how you're going to trade. If you're trading, once every 5-6 days with 200 pip stops and 100 pip targets, basically if you're trading with a pip target of triple digits, it really doesn't matter if your broker is dealing desk or non-dealing desk. Because the most important thing is that they just simply execute you at the most reliable price, always honor your stops, and generally do a very good job on the back end. If you're trading for 10 pips or less, not only do you need to have all of these things in your arsenal, but you absolutely must have a broker that is trading ECN. If your spreads are anything bigger than 3/10 of a pip, not 3 pips, but 3/10 of a pip on a euro dollar, and you're trading for less than 10 pips, you're probably not doing the best job possible in terms of your trade ability. And then, the number 4 component is also extremely important. And it's extremely important, ironically enough, everywhere, whether you day trade or swing trade. One of those things that I just constantly have to, it's something that's proven to me every single day, 100 times a day, and yet it's so hard to absorb it, which is a sensible price tag. This is one of the most, I think, core components of why Warren Buffett is so successful, and that's one of the key things that we can take away. So that's speculation. Everything else is an investment. So let's talk about number 1, which is the most important core. How do we understand a trade? What is it about a trade that we need to know in order to give ourselves a intelligent assessment of our risks? When we're looking at trades, or when we're looking at the FX market, we really look at this very, very simple formula. We call it the 3 M's of FX, which stands for macro, micro, and monetary policy. And if you don't remember anything else from your fundamental analysis from this whole course, the 3 M's will pretty much save you, or pretty much guarantee that you'll know 95% of what you need to know. Macro simply stands for the big picture of the particular currency or the economy or the country that you're following, right? So the big picture in London is Brexit. The big picture in the US is Trump, new administration, new possibility for unregulated economy. That's the big picture. Macro basically stands for big picture, right? Micro is all the everyday economic releases that flood the market that we watch, right? And a string, like a string of multiple micros, either confirms or rejects the macro thesis, right? One of the interesting things that I think has happened in the pound, for example, is that we've had a whole bunch of micro that actually is much better than the big macro picture. And whenever you have these kind of divergences, it's a very, very interesting point to look at. So you can either have a confirmation of the macro picture, which is very positive for, let's say, whatever the macro indication is, or you can have a rejection of the macro picture, at which point you may have an absolutely different kind of a trade, the opposite of what the macro idea is. And the last and extremely important, this is the single most important component of FX, is monetary policy. So why is monetary policy so important? Because you need to think of currencies as ultra short-term bonds. Effectively, currencies are a derivative product of the fixed income product, because every currency has essentially a short-term rate. Now, in some currencies, the short-term rate is actually negative, right, these days. But it doesn't matter. Currencies are intrinsically, by their very nature, they're money. So the money either pays interest or, in our times, sometimes deducts interest. But interest is what provides value for all that money. And who sets the interest rate? Monetary authorities, which is why monetary policy, single most important thing, which is why monetary officials are far, 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 far more important than political officials in the FX market. So macro, micro, monetary policy. Is that clear to everybody? I just want to make sure that you guys fully understand the components of how we assess trading environments. This is what we do whenever we look around, and that's sort of the top-down approach that you start out with, And against that background, you can then just sort of look at the bigger global picture, right? And the bigger global picture really is what we call the G20 economy, because that's really what we operate in. G20 economy is basically North America, Europe, Asia with Japan, right? And Australia. Australia is considered to be part of Asia, and China. And that's basically it. Yes, India is important. Yes, Africa is there, but none of those are really big stories that drive the FX market. The FX market is even Latin America is something we don't really trade, right? When we talk about the FX market and the majors, we're really talking about North America, Europe, Asia. Those are the three big factors of the world, and you have to look at all those parts of the world on a top-down approach, right? So when we look at the big stories now in the world as we live in right now, we see that we have on the U.S. side a Fed that is clearly moving towards a tightening bias, right? The market is absolutely convinced that they're going to tighten 25 basis points, and then when we go forward, the very longer term picture is that the Fed is effectively going to shift from its neutral stance, in which it's been for the last almost 9 years, right? It's almost been 9 years since the 2008 great economic crash, towards a more normal monetary policy. And a more normal monetary policy is basically, as the economy grows, interest rates rise in order to control the growth and control inflation, right? Now, the reason why a lot of these trends may be accelerated in the U.S. Background is because the election of Donald Trump has unleashed a lot of positive market sentiment, because the market believes that Donald Trump is going to come in and lift a huge amount of regulations off the U.S. economy, may even allow for smaller corporate taxes, and could allow for the repatriation of more than $1 trillion of U.S. money, which is parked outside of the U.S. because it doesn't want to pay taxes. Apple, for example, Google, huge repositories of money that's basically sitting in Ireland because they don't want to bring it back and pay U.S. Corporate taxes. So the market is very, very positive, the U.S. economy, based upon these big macro factors as we go into the next 12 to 18 months, and that's how you would assess the big stories. Other parts of the world, there are other big stories that I think are very important. So the Chinese, China has been in a slowdown for the last really 3 to 4 years. The days of the double-digit growth when the GDP was doing 10% are long gone. But, and this is an interesting but, many people have been prognosticating for quite a long time that China is really going to fall off a cliff, that China is going to enter this massive, horrible recession because there is so much bad debt on Chinese books. There's so much hidden amount of really, really poor investments in China, and eventually it's going to catch up to them. In addition to which, the countries around China are now producing stuff cheaper than China, because China has become sort of a middle market country rather than a low end producer of a lot of stuff, and that's creating a lot of competitive pressure for them. Now, what's fascinating is that all of these Chicken Little predictions have actually failed to materialize. And one of the bigger, more interesting stories that you could follow is that, remember I was telling you about the difference between the macro story and the micro data? Well, the micro data has actually been improving. The latest sort of Chinese data has been much better. And that is creating a very interesting divergence that could change the macro view from a Chinese slowdown to perhaps a more benign scenario of what's called a soft landing, where China sort of, yes, grows at a smaller pace, but continues to grow. And that's going to have massive ramifications for everybody a long time down the road. In Europe, the situation is completely different. You have massive political crisis, and politics enters FX at certain points in the life cycle. It most importantly enters FX when the political situation is sort of on the point of fracture. With Europe, the single biggest point of fracture is the whole European Union itself, right? Europe is a very unique situation where you have a unified currency, but not not a country, not a unified political union, and you obviously have huge amounts of disillusionment um, within a lot of European nations about the ineffectiveness of the euro to provide growth for everybody within very different regions. Italians are very different from the Germans, and the French are different from the Dutch, and nobody seems to be getting along to a level that's providing a unified growth pattern for everybody. So you have this huge amount of populist waves, and the same kind of populist wave that brought Donald Trump into power could very well be bringing very, very non-Euro friendly politicians into power in Europe. You could have Marine Le Pen come into to France. You could have the Five Star Movement come into Italy. You already have potentially some nationalist movements in Austria, even in Northern Europe, which has been a huge beneficiary of the unified euro. You still have a lot of populist movements that are starting to take shape. All of that is very, very threatening to the euro as a concept, and anything that's threatening to the euro as a concept is going to be very threatening to euro as a currency. So that's the big macro story that kind of overshadows the relatively decent micro. Ironically enough, that underneath all of this massive political upheaval, you're actually starting to see a slow but steady improvement in economic conditions in the eurozone. And then Japan is sort of its own island of stagnation, right? It's just not been able to come out of deflationary cycle for decades on end. The latest news out of Japan seems to be mild improvement, but the Japanese really just have not been able to institute enough reform into their system to kind of lift themselves away from this massive deflation that they found themselves over the last couple of decades. And the jury is still out as to whether they're going to be able to do so. So, big five themes in the macro that we're going to be watching. Of course, I touched a little bit about this, is the Trump economy. Trump economy, of course, it's really a question of whether you believe this is Reaganomics 2.0. That's really the bet the market is sort of making now. But it's quite different. There's one very, very interesting difference that I think a lot of people are missing, is that when Reagan was in office, the economy was overly regulated. The interest rates were double digits, and there was a lot of room for improvement. And there was this massive, massive technological wave that was actually very positive for the U.S. economy. We were changing everything into making jobs more productive. Now Trump finds himself, I think, in a very different situation. Interest rates are at all-time lows. The population is much older, so you have a just massive amount of welfare payments to the older part of the population that just don't go away. And any interest rate rise would be extremely, extremely difficult for the government to absorb. And technology is as much a threat as it is an aid to the economy, because it's actually destroying a lot of labor, which is destroying a lot of demand. So it's interesting to see whether the Trump economy in the long run is going to play out. But in the short run, there certainly are a lot of pros for the move, and certainly pros for a stronger dollar. This is another thing that, by the way, could have positive short-term implications and some quite negative long-term implications, because the strength of the dollar is certainly very good for the U.S. in the near term, and the dollar rally is very likely to continue. But at a certain point, and that point could be very, very soon, it becomes very, very difficult for U.S. corporations to manage the strong dollar, because the way if you look at the Dow Jones 30 or the S&P 500, something like, I think, 80% of the companies in the Dow Jones 30 are actually American in name only. They're basically multinationals that make most of their money abroad. So what happens is they have to source all their goods and labor in dollars, but then sell everything in other currencies. And if the dollar continues to rise, it really compresses their profit margins in a very negative fashion. So while it's positive for the near term, it could be very negative for the long term. Then the Eurozone political crisis, of course, is just a continuous slow motion car wreck that we're all watching with a high degree of, I think, concern. As I'm talking, of course, the next biggest flashpoint will be Italy and Austria, and then beyond that will be France. And then beyond that, who knows? It could even be Germany. There's a big nationalist movement even rising in Germany. So the point being is it's going to be incredibly challenging over the next year for the European Union to basically hold its center, right? And that is going to be, it's just a critical story. And it may not be sort of a sudden story. It could be one of those kind of things that sits on the sideline for quite a long time, and then it just flashes up all of a sudden. But it's very much worthwhile to pursue because I don't think the story is going to go away anytime soon. And of course, that story was really precipitated, was really triggered by very much the Brexit situation, right? The first country to break the union has been UK. And the thing about UK is that it's not just, you could say, well, it's not the biggest economy in Europe, so it doesn't matter. But it may not be the biggest economy in Europe, but in many ways, it's the most important economy in Europe because of its financial dominance, right? All of the European financial transactions, all of the primary dealing, all of the key banking was done through London. And the biggest risk to the whole European structure is not just that Britain leaves, but that there is going to be no European financial center, right? And that will create even more difficult problems for financing, for capital flows, and just for market integration. All of those things is something that I think few market players at this point are appreciating in terms of their difficulty and their potential stress on the European theater. And then number 5, we talked a lot about the slow Chinese growth, and that's actually, I think, in many ways could be a story of yesteryear. Again, I urge you to look at our 3M model and see, is the micro confirming the macro? This is the way you always look at trades. You have this macro view, and then you ask yourself, where's the evidence? And if we're going to let the New York City fire trucks go by. Just a normal night in New York City. I don't think I've ever done a webinar in my life that doesn't have sirens in the background. And this is by the way, with windows sealed. I don't have any windows open. This is sealed windows. That's how loud those things are. And I'm on the 11th floor. So just thought you'd enjoy that. As I said, watch for divergences, because divergences could give you very good clues to how the economy is working, right? So when we're looking at this broad, macro monetary policy thesis, we also need to ask ourselves, what is a single market analysis? Single market analysis is what I think a lot of traders do that is a big flaw. They basically look at just one currency pair. They watch, one story of that particular country. They watch, one chart. Very often it's a simple analysis. It's just basically buying the dollar up and buying the dollar down, right? And that can work sometimes. On some days it can work very, very well. But it is a dangerous, dangerous way of trading, because by limiting yourself to just one currency, one trade, one idea, you are effectively living in a bubble. There are the key thing to understand about the FX market is how there's just a million different little parts that all interact, and you can look at it two ways. You can say, well, oh my God, it's so complicated. I got to keep track of so much news. Or the exact opposite. You can look at it and say, wow, this is so interesting. Everything in the world that happens could have a potentially profitable or unprofitable impact on what I'm doing. And instead of just reading the news, I could actually use the news to make intelligent trade decisions. This, in my opinion, is actually one of the greatest things about the FX market is that everything that you read can be useful in terms of making a trade. And that is really unique, I think, about the FX market versus anything else. So, the sort of single market analysis used to basically believe that if US slows down, the rest of the world simply falls apart. That is becoming less and less true these days. Less and less, still true to a large extent, but less and less true. We're no longer just the dominant gorilla in the marketplace. We are just one part of a very diversified, very integrated global economy, right? And you can see, of course, China is the great offset to us. China is a huge, huge player across the world. And even though China on a per capita basis is still a very poor country, it's just the fact that there's 2 billion, or there's 1 billion Chinese, and even though they may be worth $5,000 each, that's a lot more in aggregate than 300 million Americans worth, $40,000 each, or whatever the GDP figures are. The point being is that the world used to be unipolar, meaning it was U.S. basically and the rest of the world, and now it's become very multipolar. And that is, I think, one of the big macro themes that's going to continue to grow. That I think is actually a very interesting and very fascinating thing, is that we're going to get less and less powerful as a dominant factor in the world. And it's true, if anybody who's ever traveled across the world, as I have, you can literally see this. It used to be that America used to have the best technology, the fastest cars, the best transportation, the easiest consumer experience ever, and everything just worked super fast and super easy. And now, that's not even close to being true. You can travel to 100 different places across the world where they have better technology, better infrastructure, a better consumer experience, and in many ways a richer lifestyle than there is in America. Australia is just one of them. Dubai is another. There's literally a lot of places across the world where the average lifestyle of a human being is actually better than it is in America. And that's a good thing, because it means that the world is actually becoming very, very diversified. And that allows you to not have to, again, look at this one-on, one-off idea when you're examining things. But the dollar is still the reserve currency of the world. And so it's extremely important to see how the dollar performs in its aggregate basis, right? And this chart is actually quite truncated. It's only to about 213. The dollar now is like right around here. We're like, at 14-year highs. I think we're actually, where are we? I think we're somewhere around here even. I forgot the dollar index. We're like 105. I mean, just quite higher. Now let me not misguide you. Let's see what a dollar index is. We'll go into my charts. I'll pull up the quote. I literally never look at the dollar index, but let's just see where we are on the charts. So if we go here, we're going to go to the dollar index. Where's my dollar index? I thought I had it. Well, here it is. Yeah. So we're basically over here, right? So 101, quite high in our charts. So if we go back to here, we're like right over here. We're quite high. So the thing about that is that when the dollar gets very, very strong, it's good temporarily for the U.S., but then it's also quite bad for the rest of the world. And the reason why is because, first of all, there's a lot of countries that peg their currency to the dollar. That makes their currency very strong and makes it very difficult for those countries to export their way to growth. But secondly, there's a lot of countries that issue debt in dollars because, the market just doesn't trust any other currency as a payback mechanism. And if you issue your debt, if you're an emerging market nation and you issue your debt in dollars, and the dollar becomes very, very expensive. I mean, the dollar was here, now the dollar is all the way over here. It's very expensive for you to pay that debt back. So that's another key thing that you want to keep your eyes open, for other countries, because if that dollar strength becomes a stress, you certainly want to be able to to be aware of it. Now, the key thing here is that you really want to have an inter-market analysis. If why is having an inter-market analysis important? Well, I'll go through the various reasons, but we have actually a very useful little chart here that will put everything that I'm about to tell you in a nice little visual package. The idea basically is that they say happy wife, happy life. Well, happy trader means happy markets, and what that means is effectively is that generally markets tend to kind of be very correlated. If everybody's feeling good about risk, it's going to translate not just into the equity market, but it's going to translate itself into the bond market. It's going to translate itself into the options market. It's going to translate itself into the currency market. One way that we all measure risk is, of course, the VIX ratio. The VIX ratio is the put-call ratio, and obviously the higher the VIX goes, the more fearful the market is. If this number is at around 10, the market is extremely complacent about risk. And if this number is at around 40, the market is really freaking out about risk. And you can see this number was as high as 70 in the time of the 2008 collapse. Anywhere above 20, and the market starts to get a little jittery. It's by no means a universal view of risk, but it's just a great shorthand. And you should be watching the VIX carefully. And if the VIX is above 20, you should be very well aware of the fact that it's going to have a broad implication across a lot of sectors of the financial industry. So a lower VIX generally means the stocks are going to rally, commodities generally going to rise because more money is going to go. Not even necessarily they're going to rise because there's so much demand. Remember, commodities are 95% speculative, 5% fundamental, right? In the oil market, 5% of the actual oil gets traded, and then 95% of it is specced out. So it's really about how people feel about risk. And if they feel positive about risk, they just simply run up commodity prices just based on the speculative flow alone. Bond prices tend to fall, so the yields. This actually is incorrect. Yields fall. I'm sorry. This is that. I gotta when I send this to you guys, I will fix it. I'm sorry. This was this is a wrong. I was looking through this thing. I just did not notice this. So, what happens is. Oh no! I'm sorry. No, this is right. I'm looking at we're looking at when things are positive, yields rise. That's right. Yields rise, bonds fall. This is the inevitable mistake everybody makes. When that means market feels good about risk. They're willing to pay more for yields, and you have a rally in forex, right? And then you have the inverse where you have the higher VIX, and everybody goes into what's called risk aversion. Risk aversion is where everybody kind of turns into a porcupine. Turns themselves inward, and everything collapses. Prices start to go down. All the money goes into bonds. Yields go to zero. Yields go to negative, right? People want safety so much that they're willing to actually be punished with a negative yield just to make sure that their money, it becomes a return of capital, not a return on capital. When you have positive market environment, you're always looking for return on capital. When you have a negative market environment, you just return of capital. Is that clear to everybody? I just want to make sure that you guys are kind of absorbing this. Any questions, anything else? Let me just sort of stop here for a second. Make sure you guys have absorbed all of these big macro flows. Yeah. Okay. So I don't see any questions. So I'm assuming it's all clear to everybody. So the other thing is to watch for is when there's market divergence, where when one market is acting like they are worried and the other market is acting like they're happy. And that gives you some very interesting trade opportunities as well. So when you're looking at specific currencies, here's some shortcuts for you to watch when you're watching the markets. For the euro dollar, it's really important to watch equity markets, which is the S&P 500 and the German DAX. It's important to watch the VIX. And then in secondary order, commodity prices, European bond yields, and then euro yen and euro pound, because in addition to just the broad market sentiment and how investors feel about a risk, and usually, the higher the risk, the better the euro is going to trade. These cross-market flows between euro yen and euro pound could have a big impact on the euro itself. Now, dollar yen is really as clean an instrument on risk as you will find in the currency market. I mean, except for dollar Swiss, which is a much less liquid and a much more jumpier trade with much higher margin requirements. Dollar yen is sort of the most liquid way to participate in the idea of risk on, risk off, right? Generally, if you have a positive risk environment, look at dollar yen as we've had this big, massive rally on the Trumponomics idea. It was 101, it's now almost 115, and that is very much a risk on proof that the market is feeling very good about risk and therefore is buying dollar yen. When the market feels very, very negative, they're selling dollar yen. Now, people ask me this all the time. Why would the market want to buy the Japanese yen, which is such a crappy little economy, never has grown in the last 25 years, has a huge amount of government debt? Why is that considered to be sort of a safety mechanism that everybody runs to? And the answer is actually quite interesting. It's not. It's not that people run to the safety of the yen. If you really want a sort of a safe haven, safe harbor trade, it's really a dollar Swiss trade. It's people run to the Swiss franc. Now that's a pure safe harbor trade. I mean, good as gold is the unofficial moniker of the Swiss franc, right? But the reason why dollar yen does so well, or excuse me, the use of Japanese yen does so well when the market feels panicky, is actually mechanical. So for the last 20 years, the Japanese yen has basically been either 0% or sometimes even -%, right, in terms of yield. That makes it extremely, extremely lucrative to borrow in Japanese yen, to borrow money, from Japanese banks in Japanese yen, and then take those loans and invest them into highly speculative ideas, equity markets, commodities, whatever you want to speculate on. You have this basically interest-free loan, right? Now, you bought all this stuff, and typically you buy all this stuff always on margin, right? And then the market starts to panic. And now the asset that you bought, let's say the Nikkei or the S&P 500, starts to come down, right? Starts to sell off. So what do you have to do? You sell the asset and you repay back the loan. When you're repaying back the loan in the Japanese yen, the value of the Japanese yen begins to appreciate. So it's this mechanism of repaying the loan. If you borrow, the yen is going to go down. If you repay back the loan, the yen is going to go up. And of course, this is not an unknown mechanism. Everybody in the market knows this. So the moment the market starts to come down, speculators are actually going to sell the yen ahead of all those repayments and just exacerbate the movement. Which is why when you watch dollar yen and you see it fall, it can fall 200 points in 5 minutes, no problems, all the time, because of this particular dynamic, right? When people decide to just get out, it's like 5,000 people running for the same exit in a Las Vegas hotel. So I hope that people understand now why the Japanese yen is sort of the. Is that clear to everybody? Somebody just give me a yes or no. Why the Japanese yen is such a prime marker for risk on, risk off trades. Let's see. Is that clear to everybody? Yeah. Okay. Right. So Hung wants me to repeat it again. The idea here is this: Japanese yen, very cheap to borrow. It costs no money to borrow. So when you want to speculate in markets, you borrow in Japanese yen. And if things are good, if you bought U.S. Stocks and they go up, great, right? You keep borrowing more yen. But then if U.S. stock starts to go down and they drop and you lose money, what's the first thing you do? You sell your losing position and you pay back the loan, right? The loan is in Japanese yen. When you're paying back the loan, you're basically going out there and buying the Japanese yen because you got to pay it back, and that's what drives dollar yen lower. Okay. Now, pound dollar, the markets you want to watch there is the FTSE, the euro, the UK yields, very, very important. And of course, these days, really, really important to watch the euro pound flows because that has a huge impact. In the Aussie, Aussie is a very risk sensitive currency because it has a high yield. One of the biggest carry trades, one of the biggest risk trades is people borrow the Japanese yen and buy the Australian dollar. The Japanese themselves do this all the time. The Japanese housewives do this all the time because they can't find any interest payments in Japan. So what they do is they sell Japanese yen and buy the Australian dollar. The Aussie yen is a huge carry trade, right? And so when things are good, that's great. But when things are panicky, right, and everybody starts to get out of risky markets, the Aussie yen starts to go back down, and that's when it comes back down quite a lot. In addition to which, of course, Australia is very, very sensitive to commodity prices, especially copper and gold, and we watch those in the Chinese market. With New Zealand, same kind of components, same sort of dynamics. It's a high yield currency, very, very intrinsically tied to Asia Pacific, but also in addition to which, very, very tied to dairy prices. So we watch the dairy prices in New Zealand. We talked about that in our last webinar, and you can review it. And with the Canadian dollar, it's just a trade in oil. I mean, it's just an insane trade in oil, right? The more volatile oil is, the more volatile dollar CAD is. It's crazy. If we have a 5 to 7 to 8% move in oil, it doesn't even matter what the Canadian economic data is. It's dollar CAD is going to move on how the oil prices move. When oil is calm, then people start to look at other things like the U.S. dollar, Toronto Stock Exchange, the intrinsic, value of the Canadian economy. But generally, it is such an oil-based currency that it's very, very hard to separate it from that particular factor. And with dollar Swiss, as I said, dollar Swiss is the as good as gold currency. That's the one that everybody really, if you really, really fear the end of the world, that's where you go. Unfortunately, or fortunately, from their perspective, it costs you a lot of money to be safe. It's not cheap. It's not free. It's actually cost you almost 1%. If you really thought the world was going to end and you bought a lot of Swiss, you sold dollar Swiss, you bought a lot of Swiss francs, it actually cost you 75 basis points, maybe as much as 1% a year. So you're basically saying, I'm happy to have 990 Swiss francs at the end of the year versus the 1,000 I gave you because all my other options would be worse. That's the trade in dollar Swiss that you're doing. So here's the very, very good little table which helps you kind of understand how things move. Gold. If gold rises, dollar declines because gold maintains its intrinsic value in terms of stress, right? It's also positive for the Australian dollar. It's also positive for the New Zealand dollar. That mainly, it's a small producer of gold, but it's really much more sympathy than actual physical gold. Australia is much more of a physical gold producer. Its gold rises, the Swiss franc rises because Switzerland is the sort of good as gold currency in the currency market. Canadian dollar also is a big beneficiary of gold, and Canadian dollar is also, of course, a big beneficiary of oil. So you have all of these nice little relationships that I think is worthwhile to watch. Now, I will talk to you a little bit about how you can follow all of these things sort of in one single screen. But it is important to keep an eye on equities, bonds, commodities, forex. All these things every single day you should be knowing. You should know where where all those prices are. You should also have a general idea. This is not extremely important, but it's a once a week kind of a thing. You want to glance at it. You may want to read about it. The Commitment of Traders Report. This is basically how are the currency futures markets in the U.S. positioned, and its only true real value is when they're at extremes because this is a small part of the overall currency market. It's maybe about, I guess, 10%. But what it does is it's the only publicly available information as to how the big producers and the speculators are positioned. And if there's a massive speculative short or a massive speculative long position on one side, basically the market is skewed to one side or the other side. And the general rule of interest is if you're at a 52-week high on one side or the other side, you should be paying attention because generally, if speculators are very, very long and what's known as commercials are very, very short, the speculators are generally always wrong. They're momentum buyers, momentum traders, and that's always going to hurt them, right? Key micro trade data that is important to watch always when we're looking for this, subcomponents of our macro theme. And labor data always the most important. ISM the second. Consumer spending the third, because consumers are always the single most important component of the economy. And then after that, you look for inflation numbers and the GDP growth numbers on that side. Now, monetary policy, the key thing here is to really know who the players are, what the mandate of each central bank is, and what their general broad policy is. So, of course, the Fed, run by Janet Yellen, has a kind of an unusual mandate. It must manage both growth and inflation. And right now, it's really been focusing much more on growth for the last really 6 or 7 years. It couldn't care less about inflation. But now with inflation starting to really pick up, the Fed may begin to shift its focus towards containing inflation. That is very bullish dollars, because that means they're going to put their focus now on raising rates, because that's how central banks focus on inflation. That's why it's important to understand the mandate of that particular bank. Now, the ECB bank is actually, look at Mario Draghi. Mario Draghi always looks like he's in the midst of meditation. The ECB has only one mandate, which is price stability, which is basically controlling inflation. But because they've actually been in a deflationary environment, they've been doing everything in their power to manage growth, to increase growth. They've been succeeding, I think, to a much greater extent than the market realizes. But the critical thing to watch here is whether they decide and say, we are out of deflation. Them, stating they're out of deflation is an interesting move, because that's actually positive Europe, because what that means is they're not going to add any more QE. They're not going to go out there and buy any more bonds if they decide that they've been able to beat deflation. That's going to be a very interesting conversation over the next year or so, whether they're going to communicate that point or not. So far, I think the signs are too premature. It's too premature for the ECB to consider pulling its QE policy. And that's what makes the euro-dollar trade so interesting, because you have this big divergence between the much more hawkish Fed and the relatively dovish ECB, and that is a long-term negative for the euro, long-term positive for the dollar. Now, the Bank of England is in its own unique world. It's actually run by a Canadian, by a guy named Mark Carney, who used to be the head of the Bank of Canada. Very, very smart guy, very, very capable technocrat, but finds himself in a miserable position of having to manage the Bank of England while they're now in a situation of trying to break away from the European Union, which he thought was a huge mistake. So they have to walk a very fine line. So far, he's had sort of the best of both worlds. UK remains in the EU and has a very, very low currency, because the currency got completely smashed as a result of the Brexit, and that's been actually creating very positive growth in the UK economy. But as they get closer to the whole idea of actually triggering a Brexit, it's going to become a much greater challenge for him. And he's got quite a lot of policy tools, to work with, right? So we've taken up, almost 50 minutes of our presentation, and I hope you guys, again, I seem to always run over on these things, so I hope you guys will indulge me. I'm probably going to run over about 10 more minutes on this, but it's worthwhile to for us to just be very thorough, because the other part of this presentation is so valuable, the resources. But we've just gotten to number 2. But these 2, 3, 4 parts of the presentation are actually quite simple, because, as I said, the really big part of figuring out is what's the trade, right? We just basically delved into all the components of what makes a trade. The next thing that's very mechanical in many ways is a trend in your favor, right? I mean, the trend can be determined very simply on the chart. I literally don't even need anything. I don't even need moving averages to kind of tell me if something is in trend. You can see with your naked eye if something is falling or rising, or it's just basically kind of, marking time in a range bounce. But, of course, just simply using a 20/50 SMA, very, very simple way to gauge whether we're in trend. The other, by the way, sort of this is a very interesting thing from a technical point of view. Here's the thing. Here's how you know you're in a good quality trend, right? Here's how you know you're in a BS trend versus a good quality trend. And this I think goes back from our prior lessons, but it's important to refresh it. If you have a separation of moving averages, first you got to have one below the other, right? So the low, the 20 has to be below the 50. That's number one, and then they have to be separated, right? If one is above the other, or one is in between, or doing a little spaghetti work, you don't have a clear trend. The clear trend in this particular chart doesn't start to occur till really like May, right? May 7th. That's what, like right around here. That's when you start to see a clear trend. You see moving averages line up properly and separation. Only then Can you really make an assessment of this as being a clear trend, right? Now, we talked about the idea is the management reliable? The key question now is your broker reliable? And I talked a little bit about what I thought was the key regulatory agencies. In my opinion, as I said, NFA US, ASIC in Australia, FCA in London, and of course, as I said, Hong Kong, Singapore, Japan, those are just not areas that we're very familiar with, but they're all very, very legitimate places to do business, right? What's not a legitimate place to do business is the British Virgin Islands. It's not the Cayman Islands. I don't know, be some ridiculously little place in offshore somewhere else. Could it be a legitimate broker? It could very well be a legitimate broker, but the chances are that it's not quite high. If you don't have a respected regulator that's observing the broker, you don't have any recourse. That's the bottom line. That's the bottom line. And that's very, very important to have. And these are really important things also. Local office is important, but I think the much more important thing is 24-hour support, right? I always want my broker on the phone. I want to be able to call somebody and have them pick up the phone within 3 minutes. If I can't get a broker on, this is actually a very good test of whether you want to give the broker a lot of money, right? Drop a little money into the account, and then just randomly call them 2 or 3 times and see how long it takes them to pick up the phone. And do it like on a Sunday night. Do it on a Friday afternoon. Do it in places at times when it's not obvious that they're going to get a lot of calls. And see how well they're doing it and whether they're able to be very helpful. That's a great way to determine whether the broker is good or not. And then of course, how long they've been in business, what kind of resources they offer. All those things are very, very important. Now, lesson number 4, extremely important. Are you paying up or coming in on a retrace in terms of your trade? This is what made Warren Buffett, in my opinion, Warren Buffett. Warren Buffett buys, this famous saying, you buy straw hats in the winter, you buy fur coats in the summer. Warren Buffett loves to buy discount because when you buy discount, you have a big margin of error, right? If you're buying over here, where's your margin of error? You don't have any margin of error. You're falling off a cliff. And even if you're falling off a cliff here, you don't know if that's the end of the story or just a pause, right? You don't know. You've lost like 500 points over here, and you still don't know if the trend is over or not, right? Whereas if you buy over here, all you got to know is, you go down by 50 points, the trend is over, right? This is a very simple way of how you can buy at value. What Kathy, I'm sure has shown this to you already. Double Bollinger Band strategy, where you just lay down 2 Bollinger Bands and you try to buy at value when the price comes down to the lower Bollinger Band. That's a good way to pick up the price, because then you're buying it relatively cheaply. And if you're wrong, if the trend changes, then you lose very little. On the other hand, if you sell over here, right, here's a downtrend, right? If you sell like right over here, you've bought at a great price. You virtually have no drawdown against you, and then the trend continues to the downside, and you've made a lot of money. Versus even selling over here. Like this is a great example of why chasing prices is not good. In both cases, eventually you would have made money, right? But if you sold over here, about a week later, you would have been about minus a couple of 100 points against you. Depending on where your stop was, let's say you had a 200-point stop, you could have been stopped out before the trend reestablished itself and you made all this money. You're basically offsides. Whereas if you came in over here, you came in at perfect timing, and even if you came in over here, it was just a mild move of maybe 50 points against you, and then you were in a much better position. So much of investing is both a function of psychological and financial strength. And the better value that you get gives you both the stronger psychological and the stronger financial strength to trade, right? Trading over here gives you 6 days of agita before the trend goes your way, and you probably don't have strength, and you probably stop yourself out before the true trend reestablishes itself. Trading over here gives you perfect entry for a huge, massive move to the downside. So that's a very, very key thing. And of course, trading plan. If you don't write it down, you just don't do it. So it's really important to make sure that you write down all those 4 factors and write down each one of the reasons for how you will trade, what you will trade, what kind of risk control you will use. It's very simple. if you really literally write it down, you'll be able to absorb your ideas much better. Um, you know, I even I'll even give you a resource for writing stuff down that I absolutely love. I just ordered this myself, actually. Amazon.com. I'll send it to you. I just looked this up. This is a really cool thing that I just bought myself because I constantly need Boogie Board Sync. Okay, this is a really cool little product. It's basically a tablet. It's really amazing. It's the first tablet in my life that I've used that writes exactly like paper. And the thing about this one, this particular version, is that you could save everything you write to your Mac or to your Windows computer via Bluetooth. Like they have a saving, and it's only $83 on Amazon. I bought a cheaper version of Staples today because I really like the way it's the first time I have iPads, I have Surfaces, I have every writing instrument I've ever had. Never have I seen a writing surface that actually mimics paper as well as this does. So it's as simple as that. It's as simple as buying this thing and just simply writing out all your stuff. Here, I'll send this over to you guys in my link as a resource. Really cool resource. Anyways, already burning up my time, so I don't want to digress any further. Let's talk about the resources. Let's talk about the other part of this presentation, which is now that we understood how we trade, let's talk about resources and see what resources we should be using as our top 10 resources for an FX trader, right? And as I said, this is all going to be in PDF form. You guys will be able to copy all of this stuff down. But I'll hit each one of these resources just to give you an idea of what they look like. As a matter of fact, I think I'm going to have to just, I'm going to take I wonder if I could do this. Oh, no, here we go. I can go. So this is the Forex factory calendar. Excellent calendar. Very simple, very clean, very nice. I like this. This is what I look at every single week. It gives you a week view. It gives you a month view. It gives you a day view. You can really see everything in broad daylight. You can filter it by currency. You can filter it by impact. Obviously, the most important impact is red. The least important impact is gray. It's excellent. It's a super simple, super easy way to look at economic data, right? Now, the second thing that's very, very cool that everybody in my room absolutely loves is this thing called news widget. All you need to do is register. You need to register. So, I have my registration. But what this does is this gives you instant. I mean, this is as fast as Bloomberg. The moment the data hits the screens, you're able to see it. So if you want instant access to G10 economic releases, they're here. It's here. It's all over here. It tells you everything you need to know instantaneously. It's a great little tool for instant news access, right? Now, real time and real quotes. Trading View is, I think, probably those of you who use it. Let me see if I can hit this. I'm trying to hit this. There we go. Hit this. This is a great free charting software. Again, it requires registration. There are parts of it where you can pay for it, but you don't have to. And it just gives you nice stickers. You can go to Eurodollar over here and pull it up by minute, by days. Historically, you can annotate stuff. It's just a nice charting software, and it's because it's all web-based. It's very, very nice and very fast, right? Here's a resource that I absolutely love that everybody in my room also uses. It's called Financial Juice. Now, this is a little bit of obscure kind of a situation. The website itself is good and it's valuable, but the real value of the website is if you log in, right, and you register, just have to register. And obviously, it's not gonna be available now because it's the weekend. But this particular service, this is what's all the professional prop traders in FX used to pay hundreds of dollars for, which is you have guys sitting in London 24 hours a day from Sunday night until Friday evening, and they have in front of them Reuters screens, Bloomberg screens, television screens, everything, and social media stuff, and they're basically doing nothing but watching for news and anybody talking. They're wired into every single political speech that there is, right? And what they will do is they will quickly tell you what news is hitting the wires. This is very valuable in fast-moving markets where you have, let's say, possible terrorist event, possible, just even monetary events. possible hijackings, whatever, or just broad, some minister does a radio interview with somebody, and they're the first ones to obviously get in touch, hear about it, and they'll tell you about it. And all of a sudden, you see the pound moving 200 points, or a couple hundred points in a minute. You understand. They give you context. It's very valuable. It's free. The coolest thing about this is free, and you can listen to it all day long, like I do, just to give you context for the day. A very, very good website that are good buddies of ours is Forex Live, and you can, and obviously they just run a 20. Every one of these guys is a dealer. Eamon is one of my favorite guys in the world. He's in Australia. So some of these guys are in Australia, some of these guys are in Europe, some of these guys are in North America. Each one of them has been a dealer or a market analyst, and they bring all of their years of expertise, and they basically update a running commentary about everything that's going on in the FX market. So it's a great place to find out what's going on. A very, very cool aspect of this thing is something that I do every single morning. When I wake up, just simply go to more, hit session wraps, and it will tell you everything that happened in North American session, everything that happened in European session. You can basically get all the news in one nice little gist over here. Let me just see if anybody has any questions here, because I'm going so fast. I want to make sure. In currency, how long does a trend last? As long as it goes. It can go for a couple of days, couple of weeks, or a couple of years. There's no such thing as a single thing. So you can copy my feeds, macro effects, which is just my combination of everybody that I follow in the FX world. To copy them, there's a link here that shows you how to copy them. You can get central bank press conferences. Remember, each one of these central banks has a live press conference. ECB is probably the single biggest one that everybody watches, but also the Fed now, every 4 times a year we watch. I mean, everybody now is broadcasting live, and you're able to use these links to get access to them. The best mobile trading platform is MT4. Absolutely, I use that all the time. It's great for both placing. Here's the thing you need to understand: MT4 on iOS or your Android on your mobile platform is not going to be able to run your EA, your expert advisor. Your expert advisor have to run in the cloud automatically, but it does allow you to get access to your account, access to your prices, and more importantly, you can make manual adjustments all the time. You can close out trades manually, you can open trades manually. All of those things are very valuable. And if you're somebody like me who's on the move all the time, it's extremely important to be able to watch all of your trades in the New York City subway and be able to adjust them on a fly. So this is a great little resource. Number 9. Number 8. Number 9 resource is something that I'm actually going to send this link to you guys. This is my own. We did this for everybody, and if you don't understand what MT4 is, you really can't trade in the FX market these days. You just literally are. You're just a sucker for the taking. So this is a very, very, hopefully simple and clean way to explain to you how do you get an MT4 EA into your computer? How do you run it? What does it do? And how does the program work? It's basically for somebody who just never wants to program, has never used MT4, and just wants to somebody gives them a program. How do you install that program? How do you make that program run? All this stuff is covered in my how-to tutorial. And then last but not least, here's a couple of free MT4 scripts that we like to use. And again, you need to watch the MT4 tutorial before you understand how to use scripts, but you can then use scripts, these 2 very valuable scripts to basically manage your MT4 EAs. So that's it. That's the resources, and that's sort of the trading structure of lesson number 6. I went a little bit over time, but not too bad. Let me see if there's any final questions, if there's anything else that you guys have. As I said, everything is going to be PDF'd, so you'll be able to get access to all of these links very, very soon. And let me just see if I have any final questions here. And I actually managed to give you a bonus tip with this boogie board thing, which will be useful for you guys, not just for writing your trading plans down, but just writing your notes down continuously. for $85, it beats the hell out of an $850 iPad. So I don't see any questions. It sounds like everybody is pretty clear. Hung, I can't explain risk on, risk off for you. If you're still having a hard time, please rewatch the webinar. I went through that 3 or 4 times. Please rewatch it. I'm happy to to answer any questions after you watch it by email. But my question is if there's anything specific that I did as far as resource, anything else over here, I'm happy to discuss. But it looks like everybody's pretty clear, right? Hope you guys found this useful. Hope you found it valuable. And I will see you guys. Kathy's going to do the next one, and then just to let you guys know, the whole end of the seminar session number 8, session number 9, session number 10 is all going to be me. So I'm going to wrap up the whole end of the course with you guys. So hopefully you'll find all of those things quite interesting. I have some very, very cool things in my arsenal of stuff to share with you when we get to that point. And for those of you, by the way, who are sort of just getting your feel around MT4, a huge part of that end of those seminars will be on that particular issue. So thank you so much, guys. Again, I will record all of this. It's all been recorded, but I will put this up on the web and get it all ready for the next couple of hours. I'll see you guys next Saturday. Everybody have a great day. Take care.